Okay. So, first of all, thanks all for joining. This is Today is actually the Bengali New Year's Day. So, for anyone who is here from Bengal or from Calcutta, Shubho Navabarsho to all of you. We start the Bengali New Year today, and it's always an auspicious day for us. So, the whole idea of this session came to me. Let me share my screen. Okay. So, the whole idea came to me because I interact with a lot of young people, especially folks who are in school and college. And what I realized over the last few years is that, although our education system teaches us to, earn, but nobody teaches us what to do with the money that we earn, right? And that is fundamental to a lot of aspects of our life, right? I mean, I don't want to overemphasize on the fact that money is important, but I think at some level, all of us realize that money is actually important, not only for covering our essentials, but also to have a good quality life that probably we all desire. It doesn't mean that we have to be extremely wealthy, and all of us have to aspire to become like say Elon Musk or Mukesh Ambani. But at least we should be in a position to live a comfortable life, given the fact that we are putting in so much effort in studying, in building a career, whatever it is, whether you are doing a job or you are in business or you're a professional. So just let me, yeah. Okay, so let me make this full screen. So the whole idea for me to have this session was one, essentially for younger, folks who are in school, in college, and who don't have a very good understanding of basic finances. So we are not going to cover, fundamental analysis, technical analysis, or any of that. Maybe we'll have separate subsequent sessions for those, just to understand the basics. But today, the main focus is to cover, uh, why we should save, what we should do with the money, the thought process behind, saving and investing and those kinds of things. Things like debt management. So all of that. So what I've thought is I've prepared some basic slides. I'll go through them, and I'll try to make it as simple as possible in terms of language, so that if I don't expect any fundamental understanding of any financial term. So if there's some term that I use which you are not sure of, do just let me know. And then the other thing that we will do is we'll keep some time for question and answers, because personal finance is inherently personal, right? And everybody will have slightly different variations of challenges and problems, and we can discuss some of the basic things here. This whole program today is more geared towards people who don't have a very sound understanding, or maybe have a very hazy understanding of personal finance and what should be done to make our lives, or make our financial lives a little bit better, right? In fact, the whole thought came to me because I wanted to teach these things to my son, and I thought, if I'm doing it, then let me sort of open it up for others, so that all those who are in the same boat at least could have a basic understanding. So with that, let me start. So, very very brief about myself. I'll not delve too much into this. I I'm basically an engineer by education. I've been in the IT industry, or I was in the IT industry for nearly 2 decades. A few years back, I decided to hang my boots and then, get into investing full time. And I've been fascinated with investing right from the beginning, right after college when I just joined my first job. So I started investing. I started writing about investments. I also write a column in the Economic Times under the Market Mughals section. Uh, I also, from time to time, write for the CNBC and money control portals, uh, and things like that. And you'll probably, you might have seen me on TV talking about specifically about the markets. So I am very interested in business models, how businesses work, how people who run businesses, how they operate, how businesses scale, etc. So that's what we do. Core competency is more of long-term investing and also looking at quant models. None of this needs to make sense to you. But when I say quant models, basically looking at just numbers and then doing number crunching for for picking investments. Value Picker is one of it's not one of, it is the largest and probably the best investing forum that we have in India, valuepicker.com. So anyone who is actively interested in value in investing should sort of take a look at Value Picker. The other thing is I absolutely love reading. I keep reading different types of books from different genres, and I'm a sports lover. Love to play and to watch different sports. And the easiest way to connect to me is through Twitter and also LinkedIn. I'm more active on Twitter. This is the mandatory disclosure because I'm registered with SEBI. That all that we discuss today is going to be for educational purposes. In any case, we will not be discussing about individual stocks. So, you know, there's no. And in any case, even during today's discussion, even if we discuss something specific to stocks, the idea is not to tell you to buy or sell that. So, what we will try and cover today quickly is what is savings, what is inflation, how does compounding work. Very important about concept about financial pyramid. Then we'll look at the ESBI quadrant. What are assets and liabilities, and then last we'll take a very quick look at what are what is investing in equities. Okay, let's go ahead. So, like I said, our education system prepares us to earn, right? But it does not prepare us to actually, it doesn't tell us what do we do after we get the money in our bank account. And that is a big problem because when I started working, first month I spoke to my dad. He told me, put your money in PPF and LIC. And it's not I'm not saying that PPF and LIC are or were bad investments, but the point is that you know people in our previous generation, most of them did not know better. So everyone defaulted to a PPF or a insurance policy, and only later, after I started sort of self teaching myself and started understanding about different investment avenues, that I could realize that these were actually very, very poor investments. And then subsequently, I took corrective action. But what I realized from that is that uh, very rarely do we understand what are the right things for me to do, what is the right mindset for me to get into, and that is why we are having this discussion on a Saturday morning today. Okay, so very, very important thing here, and lot of people assume that somebody who earns a lot must be wealthy, right? Now that is not true. First thing that you need to understand is income and wealth are two different things, right? Income is something where you are getting a cash flow, where you are getting money from time to time. Most of us, most of you will end up or will become employees or salaried, taking up salaried jobs, or you will end up as professionals, maybe doctors, chartered accountants, lawyers, or whatever. So you will get a periodic cash flow. Somebody will give you money. Now that is income. That doesn't mean you are wealthy, right? Wealth is basically your accumulated assets. Now what happens is, unless you can convert your income to wealth, you or people get into lots of all sorts of problems. And here, I have given two examples from the world of sports. Like I said, I follow a lot of sports, so a lot of my analogies come from sports. Here, the first example is Boris Becker. A lot of you may have heard of him. He was actually my first, favorite tennis player. 1985, he won Wimbledon as the first, under 18 champion, men's champion, and he was a legend of our times. Recently, he was declared bankrupt. I think today, even now, he's serving a jail sentence uh, for tax anomalies and things like that. I don't remember whether he's out or not, but I think he's still in jail. Another example is Mike Tyson, one of the greatest heavyweight boxing champions of the world. Huge number of records. Again, one of our childhood sporting heroes. Same outcome, right? He had to file bankruptcy, and all of this with despite the fact that these guys earned immense amounts of money when they were at their peak. So earning and wealth. So this is the distinction I want to make for you, you folks now, that you can be rich even if you are earning modestly. So what is the difference? Difference is earning minus your expenditure is your savings and savings. Your savings needs to get converted to wealth. As long as you are spending less than your earning, you will slowly accumulate wealth. And that is the most important thing. Okay. So here I want to leave you with two thoughts. One is, whenever you are getting a salary, as in when you start working and things like that, the first thing is, whenever you get some money, pay yourself first. What happens is, if you think about it, let's say you get a monthly salary. A part of it is already deducted as tax by the government. That is something that you cannot do anything. Then what happens is, if you have a loan, a lot of people have loans, home loans, credit card loans, car loans, etc. What happens is, you end up paying for those loans. Then you spend money, and whatever is remaining, you save that. I am saying that just reverse this process. Whenever you get some money, first save. Obviously, in statutory dues like taxes and things, you cannot do anything. You have to pay. If you don't pay taxes, you'll end up in jail like Boris Becker. So you have to pay your taxes, and then first thing is save. After saving, and I'm not saying that if you get 100 rupees, you save 90. Save a moderate amount, whatever you think. Do a budget first. See whatever amount you can save. Let's say you decide you want to save, say, out of 100 rupees, you want to save 10 rupees or 20 rupees. Save that first. Put it aside in a different bank account or something. Then go for your expenses. So that is the first lesson that you need to keep mindful of. Same thing applies. Let's say you have a birthday party and there are different people who give you some money. Okay, let's say you get again 100 rupees. Take aside some money, save, remaining spend. The second tip I want to talk to you about is always spend a little bit, one level below what you can afford. Right? See, the difference between the really wealthy is you can buy better versions of same things. Now what I mean by that is, let's say a normal person can probably buy say a Maruti Alto or a Wagoner or a Hyundai Santro kind of car. A really wealthy person can buy a Mercedes or an Audi or a Lamborghini or a Porsche. The job of the car is the same. It takes you from point A to point B. But the difference is a really wealthy person will have a much higher version of the same thing. He can afford it. Now, my point is, unless you get, so let's say, at different levels, let's say you can afford a Wagoner, buy one level below, buy an Alto. If you can afford an iPhone, buy maybe a Samsung which costs half the price, right? So and same thing everywhere. If you can afford a 5,000 rupee shirt, buy maybe a 3,000 rupee shirt. Ultimately, and more specifically, do this at the beginning, the first 10-15 years, so that the money that you can save, you can invest. And I'll show you in the next few slides when we talk about compounding, how compounding works, and the magic of being able to put in small sums of money for very long periods of time, how it can multiply and become very large sums of money. Okay, so two important thoughts here. One is buy one level below and pay yourself first. Okay, the next interesting concept that we need to understand is the concept of inflation. Now you might have heard of this term. What does inflation mean? Now inflation means that what you bought say 10 years back or 2 years back at 100 rupees today is costing you 120 or 110 or whatever. And here I'm actually giving you, I've put in two examples, and it just shows you in a more in the face kind of manner how things have changed. So this is 1971, two masala dosas, 1 rupee, so 50 paisa for a masala dosa, and 2 cups of coffee again for a rupee. So total is 2 rupees. Okay, so think of it, one masala dosa you are getting for 50 paisa. A few years later, 14 years later, again another food bill, 1985. Look at the prices. Shahi paneer, 8 rupees. Dal makhani, 5 rupees. Right? So, anyone who, if you relate it to today, a masala dosa today will cost you, depending on where you eat it, it will cost you between, say, an 80 rupees to maybe a 200, 250 rupees. Right? Roughly, let's say, even if it is 100 rupees. So in a period of 50 years from 1971 to today, a 50 paisa masala dosa has gone up to become 100 rupees. Right? Same thing will keep happening in our lifetimes as well. So what is happening here is that you will end up having a lot of money. You will end up having a goods costing you a lot of money, more. So today if you think that, okay, if I have 1 crore rupees for my retirement, that is enough. By the time you retire 30, 40, 50 years later from your active job, you will find that, maybe a masala dosa will cost you 1,000 rupees, or a masala dosa will cost you 5,000 rupees. And that 1 crore that you thought was sufficient is making you just scrape through life, right? So, so the basic understanding that you need to have is inflation is the rise in prices of goods that we buy, goods and services that we buy, that keeps on rising with time. The other interesting thing that we are having is our life expectancy is going up. If you think about the past, if you read history, or if you read novels or literature from say 100 years back, you will find that people who are in the late 40s, early 50s, they were termed as old people. Now, most of the time, we consider people who are say above 70 as old. Life expectancy has gone up in India from 60s to mid 70s, and it is likely that in the next 20, 30 years it is even going to go up further. Now, why am I saying all this? I am saying all this is because our working span typically for jobs is not going up. People are still working, say, from an age of 23, 24 to an age of 60, 62, 63, right? But people earlier were, not living beyond say 65, 68. So their accumulated wealth needed to be sufficient for another say 10 years. Today, their accumulated wealth needs to be sufficient for 20 years because people are living till 75, 78, 80. By the time all of you, get older, get to your retirement age, maybe the average life expectancy will be 100. So very, very important for you to understand that your earning power of the money that you save is going to go down. Okay. Now, this is a very interesting thing. I spoke about compounding, right? So here I have put in two tables. In one, on the first table on the right, on the left, I have put in, I'm saving 5,000 rupees per month for 10 years. Okay. I have no money to start with. Every month I'm putting in 5,000 rupees and I'm doing it for 10 years. Okay. Sorry, this is the table on the right. And I'm assuming I'm getting a rate of return of 12% every year. At the end of those 10 years, I will more or less have 11.8 lakhs. Okay. So 5,000 rupees every month. At the end of 10 years, I will have 11.8 lakhs. If I keep doing the same thing for 30 years, right? Same thing, I keep the 5,000 rupees every month for 30 years. Now, instead of 3 times of say 12 lakhs, which would have been 36 lakhs or 35 lakhs, I end up having 1.6 crores. Right? So just think about it. If you have learned compound interest till now in school, do this exercise. I have given the link here. There's a money control tool called Magic of Compounding. Play around with it and see. Put in your numbers. What you will realize is that, so in the same scenario, let's say one person starts today saving 5,000 rupees. The other person says, nay, I want to have fun. I'm just starting to earn. Let me start investing 10 years later. So somebody starts today, let's say when he is 20, and the other person starts when he is 30. Both of them put in 5,000 rupees every month. Okay. The second guy needs to put in 16,500 rupees to get to that same level as the other guy. So think about it. So one guy puts in for 30 years, the other guy puts in for 20 years. The difference is the first 10 years, the second guy doesn't do anything. So the remaining 20 years, he needs to put in more than 3 times the money to get to the same level. And that is why I said in the previous slide that it is very important for you to start early, even if it is with a very small sum of money. Even if you spare 500 rupees a month, 1000 rupees a month, do it. Because that will compound over the next 10 years, 20 years, 30 years. Right? And after 10 years, 20 years, 30 years, that sum of money starts becoming significant. Okay. Now, again, is a very important basic thing, which is the savings pyramid. Okay. Now, what do I mean by the savings pyramid? Here is, let's say you start now earning. You've gotten you got out of school and college. You've got a job. How will you start? You are earning 100 rupees a month. What will you do after that? Right. The first thing that you need to do is you need to start at the base of this pyramid. You need to create an emergency fund. Now, typically, I would say 2 to 3 months of your basic monthly expenses is sufficient. So let's say assume that your family expenses is 50,000 rupees a month. You need to then keep aside 1 to 1.5 lakhs in a separate savings account. Preferably should be a joint account with either your parent, or if you are married, with your spouse, whoever. I mean, the whole idea is, because it is an emergency fund, this should be accessible to more than one person in an emergency. Right? Do not try to get do not try to make try to get the maximum out of this particular uh, fund. Don't think that I'm getting a little bit more interest in this particular thing, let me put my money there. Don't put your money in questionable schemes. The best is to keep it in a savings bank account, where you can easily get access to it. If in this example I've taken family expenses of, let's say, 50,000. If you think that 1 to 1.5 lakhs is a lot of money, obviously it will be a lot of money when you're starting. Start putting aside a little bit of money every month, so that you can get to that stage. Maybe you start with a target of having 50,000, so 1 month, then slowly increase it to 1.5 months, then 2 months, 3 months, and by that time you will also understand that uh, after, let's say, you are doing this and you've kept the money aside for a year and a half, you already know that what are the circumstances under which you are having to dip into that fund. Don't use this fund for your consumption expenses. Don't go and buy a mobile phone with this. Don't go and eat at a restaurant with this. Don't go for a vacation with this money. This is an emergency fund. Something really bad happens, some medical emergency happens, uh, uh, you know you get laid off from your job, those kinds of things. That is when you need this money. Okay. So this is the base of the pyramid. The next level is you need to get uh, protection. You need to manage disaster through insurance. Now, when I say disaster management, what I mean is, in India, typically, what we find is that most families or family financials get completely derailed because they don't have enough medical insurance, or they don't have, they have one earning member and that earning member prematurely passes away, so there is no life insurance or there is no adequate life insurance. These are the two conditions we see very commonly. So very important, get a health insurance in place for yourself and anybody who is dependent on you. So if your parents are dependent on you, get a health coverage for them. So that health insurance is very very important, because today, and more importantly, the more we go in the future, healthcare is becoming more and more expensive, right? And it is psychologically very difficult if you find that somebody very close to you is very sick and you cannot afford the treatment, the hospitalization, etc. So it is very important for everyone to get health insurance. Now in health insurance, what I have personally found, and you can check it out for yourself, there are enough resources on the internet today to find these things out. And when I sort of refer you to the internet, the best thing is always go for credible sources. Don't listen to a lot of people on who are doing Instagram reels and those kinds of things, because unless you know that they are a credible source, because most of these people who put up stuff on social media are doing it as promotions and not telling you they have something to sell to you, or they are completely ignorant and most of them don't know anything, right? So you have to sort of protect yourself from that. Go to credible sources, go to insurance portals, go to companies which and study, spend a little bit of time to educate yourself. This education is going to last you a lifetime, right? So get insurance. What I have found is you can take a base, family floater, which sort of costs reasonable, and then add top ups to that, right? So they tend to be much more economical, much more much cheaper than if you're buying the health policy for the full amount. Okay, be on the safer side. Let's say you think that, okay, if I have say 5 lakh rupees of health insurance, that is good enough for me. If you think 5 lakh is good enough, maybe stretch it a little bit to 6 lakhs or 7 lakhs. Okay, next is life insurance. Go only for term plans. Term plans are ones where you pay a very small amount of money to cover your uh, insurance risk, right? But you will not get anything in return. Indians, we have this mentality that I am going to give money and I am not going to get anything in return. So that will become a problem. Be very clear that insurance is meant for risk coverage. Investment is meant for getting better returns. Most of the time, these two do not go hand in hand. Keep them separate. Keep your insurance separate. Keep them as term plans. And for the money you need to invest, you can go ahead and invest. Even if you have a job and your employer is covering your insurance, it is better to get your personal insurance separate from your company insurance, roughly by the time you are 40 or slightly before 40. Because what happens is, beyond that, most insurance companies, health insurance companies, start asking for different medical checkups and things like that, right? So before you get to 40, it is better to get health insurance separate from your personal insurance. I'm sorry, your employer's insurance, right? Okay. The next is debt. Now, debt is a very it's a difficult term, but ultimately, debt basically means your fixed deposits. Anything which gives you a fixed rate of return. So it is called as debt. It is called as fixed income securities. fixed deposits, all of these are basically used interchangeably, right? So let's understand, for simplicity, let's use either the term debt or we can use fixed income, right? For people who are in a salaried position, someone, if you once you get a job, most of you will have a provident fund associated with the job, where whether it's a government job or a private job. Now in that provident fund, what happens is your employer keeps aside a part of the salary and invests that in a fixed income scheme called the employees provident fund or the group provident fund or whatever. And the employer also matches the contribution. So if the employer deducts say 12% from your salary, they put in 12% in addition to that from their side, and then they put it in the PPF. So what that means is roughly you will have a decent 18-20% allocation to your provident fund, which is going to earn you say 8.5%. Now for those who are not in a job, right? So people who are like doctors, who are lawyers, who are chartered accountants, who have small businesses for themselves, a very good option for you is to go for PPF, public provident fund. You can open a public provident fund account in any bank. You can do it in a post office, and you can save, I think, up to 1.5 lakh rupees a year, and it is tax free as of now. Okay. Again, a PPF also has the government gives you a fixed rate of return, 7.5%. Now, important thing here is to automate your savings as far as possible. So let's say uh, you want to save some money every month, and you open a PPF account and you want to put in say 1.5 lakh rupees in a year. Uh, Deduct 12,000 rupees every month and put it in a regular manner, right? So in that way, suddenly you will not need to put in all the money in one shot. You can break it up into smaller chunks and keep paying it, right? The other thing is that if you need some money in the short term, right? You want to go abroad, or go for a vacation in the next 6 months to next 1 year, and you're saving for that. Don't put that money in stock market, or don't put that money in some other place. Put that money in a short term, bank FD, 6 months FD or whatever, and keep accumulating that. Here, the main idea is not to overcomplicate. Use simple bank fixed deposits, debt mutual funds, right? PPF, NPS, these kinds of tools to build your debt portfolio. You don't need to have any esoteric or very difficult things, difficult instruments to invest into debt. The next is something which is a big favorite for Indians, which is the home. A lot of people keep buying multiple flats or houses or land or whatever. Most of the time, one residential home where you personally live is more than sufficient, right? Now, if you have a business or a profession, you might then want to consider a commercial property. So let's say if you are a doctor or if you are a lawyer, and you want a chamber, right? You can then buy that because you are using that as as a means of your income. Personally, for me, buying multiple flats, multiple properties is not a good idea, and I'll come to that later in the next slide, why it is not a good idea. Residential yields, rental yields in residential property in India. Now, what I mean by that is, let's say you buy a second house and you give it for rent. In India, most of the time you will, if you know the rent you will get is going to be around 1 to 2 to maximum 3% of the cost of the property, right? So you are actually better off putting that money, instead of putting it in a uh, in a property, you are better off actually putting it in a fixed deposit, because you are going to earn more, right? Plus, in a property you need to keep spending to maintain it, to keep it clean. You need to pay municipal corporation taxes and all of these kinds of things. So it's a continuous cash outflow from your pocket. One home, more than enough for most purposes. The next is what I call, this is the top of the pyramid, and which is equity investing. Now, after you have built up the pyramid, you have taken care of your emergency fund, you've taken care of insurance, you've taken care of debt, and in most cases, as a salaried employee, debt is already taken care by you, by your employer. The next level is investing in businesses, right? Now, what does a business do? A business lets you have leverage beyond your own capability, effort, and time. Now, you as an individual can only earn a certain amount of money by your effort. The moment you take your money and put it in somebody else's business, a part of that, the business's earnings accrue to you, it comes to you, right? So not only are you working, but your money is also working for you. This is a slightly dated, maybe a few months earlier, when Forbes uh, uh, created its list of the richest people in India. Now I think the order again has changed. I think Gautam Adani is not the number one anymore. Uh, but this is the last published list that you can get from the Forbes site. Now the point here is, in this list you will not find any salaried employee. You will not find a professional. You will not find a doctor. You will not find a lawyer. You will not find a chartered accountant. You will find only people who run businesses. The reason why I have put this slide here is to drive home the point that the richest people in the world are people who run businesses. Why is it that? Because now, when you are running a business, what happens is you can use the effort, the time, the capital of many other people who are working in that business to grow that and to create wealth. When you are investing in the stock market and you are buying businesses, you are becoming a very small, minuscule owner of businesses, and a very that corresponding amount of earnings of that company accrue. That you become that 0.0000001% owner of, say, Reliance Industries. Okay, so that percentage of earnings belongs to you. You get dividends. This is perhaps the most important slide in this entire deck. This is taken from Rich Dad Poor Dad, a book which I suggest everyone to read. This book actually changed my thought process when I started, just out of college. Here, see what the author has done is, he has broken up what individuals do into uh, four quadrants. Okay, on the left hand side you have employee and self-employed. So employee is anybody who works in a company in somebody else's company. So you could be a government employee, you could be working in a private company, whatever. Self-employed is somebody who is a professional. So you could be a doctor, lawyer, chartered accountant, uh, even maybe even a small shopkeeper, somebody who works for himself, right? The other distinction here is that on the left hand side of this grid, what you do with your day is not controlled by you, right? So if you're working in a company, your boss or somebody else is going to determine how you spend your day. If you have a meeting, you cannot say I will not attend it, right? So that is the employee. Self-employed also, unless you show up for work, you don't get paid. You need to be physically present to get paid. Think of a small kirana store, or maybe a chai ki tapri, or maybe a doctor or a lawyer, right? Or a chartered accountant, who has his private practice. So a doctor, when he goes on leave or goes on vacation, he's not earning anything, right? Because he has taken a vacation, he's not working on those days, so his income has stopped, right? As an employee, if you leave your job, your income has stopped. On the right hand side, you have a business owner and you have an investor. Now, business owner is a person who employs other people. He is most of the time able to manage his or her own schedule, and he can get paid even if he is not working himself personally. Now, this uh, is, a business is when it gets slightly bigger. No, it's not a one person business, right? A cigarette shop uh, owner, a pan dukan wala, is a self-employed person. Is not running a business because he needs to be there. He needs to open his shop to earn. A business is, slightly bigger. Maybe he has somebody who has 10 employees or 20 employees or 1,000 employees or 10,000 employees. That is a business. So a person does not need himself to be working all the time. So if, let's say, a Mukesh Ambani goes on a vacation, doesn't mean that Reliance Industries is stopping to work. The work in Reliance Industries goes on, right? So Mukesh Ambani still, earns while he's on a vacation. So that is the business. So investor is a person who invests in others' businesses. Okay. Again, here he he or she is not getting uh, directed by other people's schedule, right? So, for example, I can decide that uh, if I want to work today morning or not. If I am an investor, if if you are investing, or if you are a business owner, what you have is passive income. What do I mean by passive income? Passive income means you have invested and that investment money keeps getting returns for you, right? As an employee, assuming you don't put you don't have any savings, you don't have passive income, you only have active income, right? So the moment you start saving your money, like I said in the first slide, 10 to 15, 20, 30%, you save and then you start investing that. Do you move from employee, self-employed uh, left hand side to the right hand side? So if you understand this grid, always try to move from the left to the right. Now everyone cannot become a business owner, right? And everyone need not become a business owner, but everyone can become an investor. right? You can invest in debt, you can invest in equity is basically, businesses through the stock market. So that over a period of time you get passive income means income which you get even if you don't do anything. So if you put money in a fixed deposit, if you even if you you know become like Rip Van Winkle and go to sleep for 20 years, you still keep getting the money, right? 20 years later you will find that the money that you had put in has increased, right? So your effort has to be to move from the employee, self-employed, to becoming a combination of an employee and an investor, or a self-employed and an investor, and also maybe a businessman and an investor. This is also a very, very important slide. Now, typically, what is the difference between a, say a middle class person's mindset and a rich person's mindset? Typically, you will find that a middle class person or a poor person, once they earn an income, okay, what happens is it goes directly towards expenses which comes from their liabilities. Liabilities is basically your loans. So typically you will find that you end up having a home loan, you have a car loan, you've taken education loan, you've got credit card bills to pay. So the moment you get an income, you have to start paying these people off, right? The mindset for a rich person is exactly the opposite. What they do is, the moment they get an income, so other than business income, they will have income which is passive. Either it is rental or dividend from companies or interest. Then with that money they will try and create assets. Assets could be financial assets, it could be physical assets, but assets which will again get into that virtuous loop. Those assets will create more income, right? So you end up, you earn 100 rupees, you save say 30, put that in some investment, that 30 again returns 5 rupees. You take that 5, put it back again as an investment, that 5 again earns 50 paisa. So that circle keeps going, right? So your income continuously gets plowed into assets which create more income. That is how you create wealth. Another very, very important concept, and this is a different concept from what you may have learned or what you will learn in your normal accounting. If you have taken accountancy classes, accountancy will define asset and liability in a different way. In my mind, the simplest way to understand an asset and a liability is, an asset is something which puts money into your pocket. A liability is something that takes money out of your pocket. Okay. So in the chat, tell me if a car is an asset or a liability. Okay, so Navya is saying it's a liability. Abhinava is saying it's a liability. Okay, both of you are right. Up to a point. Why up to a point? Is, in normal condition for you and me, it is a liability. But for a taxi owner, it is an asset because he is using that to earn. He has bought a car, running it as a taxi to earn money. So for him, it's an asset. But for 99% of common people, it is a liability because you have to maintain the car, you have to put fuel in it, right? So all the time it is taking money away from you. Tell me if a second house is an asset or a liability. A second house is an asset or a liability. Okay, so some of you are saying, or it's an asset. Okay, it is not an asset, it is a liability. Why? Your first house where you are staying is an asset. The second house, if you have not put it up on rent or something, is a liability, because you have to give, take care of it, you have to pay maintenance, you have to pay corporation taxes, and it is not earning anything from for you, it is taking money out of your pocket. Okay, in general terms it is going to be a liability. Now in the next slide I will make a slight difference between an appreciation asset and a uh, okay, so Abhinava is asking what is the difference between the real estate and getting a second house. So real estate is a terminology that is used for a house, a flat, land, all of it put together is called real estate. Okay, even a shop, an office building, all of it is real estate. So collectively it is called as real estate. So when I say second house, what I mean is you already have a house where you are staying in. Now for investment purposes, a lot of people, you will find that, because the government is giving a tax break or whatever, people go and buy a second house and a third house, right? The rich people do that. Now the problem is that most of the time it is a liability, because you are continuously spending money to maintain that, to upkeep that, to pay taxes on that. So continuously there is an outflow of money. Now in the next slide I will take you through a concept of something which is an appreciating asset and a depreciating asset. Okay, so let us understand this now. What is an appreciating asset? An appreciating asset, now the word appreciating here doesn't mean that somebody will, an asset will come and pat your back, right? An appreciating asset means that in general the price of that asset over time keeps going up. In India, as in globally, you will find that over long periods of time, say 10 years, 20 years, real estate, gold, silver, etc. are appreciating assets. By that, what I mean is, if you buy gold, which you will find your mothers or your sisters or even yourself, you may be buying gold as jewelry. Some people invest in gold and put up a lot of their money savings in gold, right? That is traditionally what keeps happening in India. Now gold is typically an appreciating asset, so price over time keeps going up. Same for a house or land or property, right? The price over time tends to go up. That is an appreciating asset. Okay, yeah, I know we are still in the income liability slide, we'll go there. So I'm just trying to explain to you the difference between an appreciating asset and a depreciating asset. So typically, say a car, a mobile phone, all of these are depreciating assets. So you buy a car today, 5 years later if you want to go and sell it, unless you are a superstar or unless you are buying and selling a vintage car, nobody is going to pay you more for that car. So let's say, if you are a superstar like Amitabh Bachchan, he might be able to sell his car at a higher price than what he bought it at, just by saying that, this is Amitabh Bachchan's car. Okay, but in general, for 99.9999% of the people, if you buy a car today for 5 lakh rupees and if you want to sell it after 5 years, you will get 1 lakh, 1.5 lakh rupees as sale value. So your value of that asset has, or value of that goods has depreciated, has gone down, right? Mobile phone, you buy today for say 20,000 rupees, you want to sell it after 6 months, nobody is going to pay you more than a few thousand rupees, right? Similarly, lot of other things, clothes, if you, let's say you want to buy today, sell tomorrow, I don't know if there is a second hand market for clothes, but assuming that there is. So a lot of things are, most of things in life actually depreciate in asset, in price over time. Appreciating assets are typically precious metals like gold, silver, platinum, etc., property, and sometimes art. So if you buy say a Van Gogh or a Rembrandt or some other, I'm not too well versed with artists, but if you buy uh, art from a famous artist or somebody who's going, becoming prominent, after a few years you may be able to sell it at a much higher price, right? So these are things which can appreciate in value, but in general most things depreciate in value. So you have to be very very clear that whenever you are saving and investing, you put money in things where price appreciation happens. So you invest in appreciating assets. Next most important thing is debt, loans. Okay, now loans, mostly people will tell you loans are bad. You go and read any financial book of personal finance, mostly people will tell you, loans are bad, don't take loans, etc., etc. My point is that there has to be a distinction between good debt and bad debt, good loans, bad loans. If you are taking a loan to create a appreciating asset, then you can use it to your advantage. If you are taking a loan to create a depreciating asset, you are creating a problem for yourself. Now, I've given examples of good loans. So, if you take a loan and buy real estate, buy a house, and over say a 10, 15, 20-year period, the price of the house goes up slightly, it is an appreciating asset, it is a good debt. If you had to take an education loan, you are increasing your ability to earn in future years. It is good debt. If you take a loan to increase your business, it is a good debt. Exactly opposite is bad debt, which is you want to take a loan to buy a big car, or you want to buy an expensive motorbike, or very expensive mobile phone. So mobile phone I keep coming back is because I see a lot of youngsters today uh, you know spend 2 months of their salary in buying a phone, right? And a phone that probably they will use for maybe 2 years or 3 years maximum, right? If you are spending 2 months, 3 months of your salary in buying a 50,000, 60,000 rupee phone, which you are going to use for 2 years, you will end up, so just think about it. How much of your effort you are putting into buy something. I always do that. So if you divide your earning by the number of hours you have to work to get that earning, right? Do that calculation sometime. So let's say if you are earning say 20,000 rupees a month, and you are having to work 20 days and 10 hours a day, which means that 200 hours you are working in a month, for example, just giving an example, which means that for every hour you are working, you are getting 100 rupees, you are getting paid 100 rupees, right? So that is your hourly rate. Now, to buy a mobile phone for 50,000 rupees, how many hours are you working just to pay for that mobile phone? Think about it. You have to work for X many hours, right? So be very very clear when you are taking loans uh, to taking loans for depreciating assets. Here there are two tips that I want to give you. Even if you are taking loans for appreciating assets, try to keep your debt payment, your loan installments, to about 25% of your net income. So if you are earning a certain amount of money, say 100 rupees a month, make sure that the total of installments that you are paying is not more than 25 rupees, because then it will give you enough uh, buffer for you to save, plus also to meet your expenses. Okay. The second very important thing is, let's assume that you have already taken a loan and you have multiple loans and you have some cash that has come to you. First thing is, always pay off your high interest debt. So pay off your credit card loans the first, because credit card charges you the highest amount of interest, roughly 2 to 3% a month, which is 25 to 40% a year. If you get into a credit card debt, it is extremely difficult to get out of it if you make only part payments. You will spiral off into a debt cycle. Spiral. It's very, very difficult to get out of credit card debt. So, unless you are in dire straits, never take credit card debt. Use your credit card as you would use a debit card. Only use it for the money that you have in your account and you can spend. Always pay off the entire credit card bill the month you get it. Don't roll over. Don't pay partially. Next is personal loans. They are slightly lower interest rate than your credit card debt, right? Uh, Try to pay them off as soon as possible before even saving and investing. It just work out the numbers. If you are paying a 25% interest in a loan, it does not make sense to save money and put it in something where you will get 12%, right? So if you are paying off that loan, it means that that is the minimum guaranteed return you are getting. Is this part clear? Right? If you are paying off a loan where you have which is charging you say 20% interest, and you pay it off, it means that you are earning that 20% on the money that you paid off. So if you get 100 rupees and you pay off that loan, it means that that 100 rupees that you paid off is earning that 20%. So always pay off that loan. The other important thing that you need to know in debt is, we have an organization in India called as CIBIL, CIBIL. They keep track of all your loans. So it is like your school report card. Okay. So any loan you take, whether it is through a personal loan, credit card loan, buy now pay later kind of things, all of it is tracked by CIBIL. Okay. And if you have a good credit history, which means that if you are paying off your loan at the right time, always, over a period of time, your history becomes good and you will get beneficial interest rates. So tomorrow, if you want to go and take a home loan, the bank will give you slightly lower interest rate than somebody who has a bad CIBIL score. Right? So be very careful of uh, paying off loans. Don't postpone or don't pay or don't default on loans, because once your credit history goes bad, it will take you many years to get your credit history back. Right? So very important thing, make sure that your CIBIL scores are good. Another thing which is coming up now, which not many people know, is that it is important to have some amount of credit, which means that some amount of loans. Because if you have no credit history with CIBIL, a lot of banks today will not give you a loan if you need it, unless you are a salaried employee, right? If you are a salaried employee, it is okay. But if you are not salaried employee, and if you are a self-employed person, or if you are a businessman, a bank will hesitate to give you a loan because they don't have a history. So, use a credit card, but pay off the loan every month. Pay off whatever you are buying in its complete, complete value. Okay. And then this is the last slide for today. Whatever remaining money that you have with, after you've saved your money and you've done all that emergency, you've done FDs, you've done insurance. Okay. Then you come to uh, investing in equities. Now, equity is basically nothing but the share market. Okay. And in the share market, what you are essentially doing is, when you are investing in a stock, you are investing in a business. You are becoming a part owner of a business. Okay. As a shareholder, you are entitled to that part of earnings from the business. Now, you might have heard of a stock exchange, your National Stock Exchange or a Bombay Stock Exchange, BSC, NSC. These are marketplaces where stocks are bought and sold. Okay, I'm just giving you a very high level concept here today. Nifty and Sensex are two indices. These are the two indexes that we have today. Nifty 50 is there on the National Stock Exchange, which is the larger of the two stock exchanges that we have. It is a group of the top or the biggest 50 companies in India by market value. It gets changed every 6 months. So any company who has grown in the last 6 months will move into that list of top 50, and somebody who has sort of not grown or whatever will go out of that top 50. So at any point in time, the top 50 companies by market value will be there in Nifty 50. Similarly, Sensex is an index that is defined by the Bombay Stock Exchange, and the Sensex comprises of the top 30 stocks. Okay. Now, what is a mutual fund? A mutual fund is a fund basically which pools money from different people. So it will take money from you, me, and 10,000 other people, small amounts of money, and then you have a professional fund manager who will take all that money, pull it together, and put it in a fund and invest it in different businesses. Okay. Once you are used to investing in businesses through mutual funds or whatever, if you are interested, if you are if you get interest in investing, you can move to direct equities. That is, you can go and start buying, selling companies by yourself, right? Initially, you can always buy or start your savings and investment journey through mutual funds. SIPs are systematic investment plans, which is basically every month you save a small amount of money, right? And like I said, over the period of time, it slowly accumulates, and end of say 10 years, 20 years, 30 years, you end up having a much larger corpus than what you put in, right? This In mutual funds, you will typically find a lot of mutual funds. You will find debt funds which invest in fixed deposits of different companies, etc. Different government bonds, and you have equity mutual funds. Equity mutual funds is funds which will invest in the stock market. Even in equity mutual funds, you will have multiple categories. You will have a large cap fund, you will have mid cap fund, you will have small cap fund. Basically, I will not go into the details, but what it means, large cap basically means company which are large. Mid cap means companies which are in the medium, scale, not very big, not very small. And small cap companies are small companies, right? So ideally, when you are starting off your investment, what I tell everyone is, you can start off with a Nifty 50 index fund and a Nifty Next 50. So basically, top 50 companies, and Nifty Next 50 is 51 to 100. So in essence, you are buying the top 100 companies in India, and slowly every month you keep investing in that. Or if you are a professional, right, you keep investing every, whenever you get some money, you deploy it in those kinds of funds. Over time, as and when you mature, as and when you learn more, you can start buying active mutual funds. You can invest directly on your own, or you can take services from advisories like ours or others. You can invest over time. If you become really wealthy, you can invest in PMSs and things like that. But in short, this is the framework that I wanted you to all understand. Uh, with that, I will stop for now. If you have any questions, you can either raise your hand, and then I can, or you can put your question on the chat box, or you can raise your hand and I'll unmute you and you can then ask your questions. And let me stop sharing the screen. Okay. Any questions from anyone? Okay. So if there are no questions, I had one question for all of you. Did you find this, useful? Did you think that it made some sense, or did you learn anything? And the plan is I will have a subsequent sessions on. Okay, so Navya has a question: is Nifty Next 50 good? As we had some stocks like Adani. Yes, so that is a good question, right? So at times you will have such companies, but over, you are not investing for 6 months, right? You are investing for say 10 years, 20 years, 30 years. And in a 50 stock, you will have one Adani, which may be 2%. Okay, so if you are putting in 100 rupees, Adani may be 2 rupees. Within that 2 rupees, it may have fallen 50%. So you may have lost 1 rupee. But the other stocks, the other 49 stocks will make up for that. Right? So this is also an advantage of having a diversified portfolio. So if you are investing in Nifty 50 and Nifty Next 50, you will have a basket of 100 stocks which you are putting in money every month or periodically, and over a period of time these will give you, basic market returns, 12 to 15% maybe, over the next 10, 15, 20 years. And if you do the compounding over say a 20-year or a 30-year period with a 10% or a 12% return, you will find that that amount becomes significant. Once in a while you will always find stocks like, what happened to Adani. You will find, even if you are doing that investment yourself, not all the stocks that you will choose will always go up, right? You will always, in investing we say, if your hit rate is 60%, then you are doing great. Even the greatest of investors have a hit rate of 60%. What it means is, if they pick 10 stocks, 6 are winners, 4 will not do anything, out of which maybe 2 will not, go up or down in price, and 2 where they'll lose money, right? So okay, next question is Tushita. What are good investment options for a person who has just started earning? I think the best investment option is, if you just started earning, is to put your money in Nifty 50 and Nifty Next 50. That is to start with. Start building up a corpus, and then if you are interested in the stock market, start learning about it and start investing slowly in direct stocks which you understand. Study the business, and then slowly start investing in those. Over the next couple of months, I'll do a few more sessions on how to analyze businesses, if the basics, whether through fundamental analysis, through technical analysis. We'll do those sessions. So hopefully, we'll have slightly better understanding. Okay. Any other questions from anyone? Okay, so we've spent nearly an hour and a half on a weekend holiday. Thank you all for joining, and thank you. If you have any questions, do feel free to reach out to me on Twitter or on LinkedIn. Right? Thank you. Thanks all for joining.